Hi, everyone. Welcome to the webinar. Thanks so much for joining us today. I'm Katie Flynn, Content Director at savingforcollege.com, and in just a minute, you'll be hearing from Joe Messenger, founder and CEO of Capstone College Planning. Today, he will be discussing the 9 key differences between the 2 financial aid forms, the FAFSA and the CSS Profile. Everyone who attends the entire webinar is eligible for 1 hour of CFP CE credit, and you'll receive an email immediately following the presentation that contains the CE credit form and information about a special offer from Capstone. As part of our new partnership, they're offering you a discount on their training coursework, which we feel is a great complement to the tools that we offer on savingforcollege.com. And just for registering for today's webinar, you're entered to win a free copy of savingforcollege.com's updated complete guide to 529 plans. You can also purchase this book on Amazon or on our website, and we do offer discounts for bulk subscriptions. I'll announce the winner of the giveaway at the end of the presentation. Joe will be taking questions during the webinar, so if you have anything you'd like to ask, please enter it into the question box in your control panel. And with that, I'll hand it over to you, Joe.
Awesome. Thank you so much, Katie. I'm really excited to do this particular webinar because I think it's hopefully will be really good things for all the advisors to take away and have some additional knowledge. And we will be sending out the slides as well. I know we've got a lot of questions on that. So hopefully you get a lot out of today, and we'll get rolling. So want to provide a little context on who Capstone is and what we do. Really what drives behind everything that we're doing is our mission to end the student loan crisis, one family at a time. And our belief is that to do that, we really need to raise the bar in college funding advice across the industry. So we have a tremendous amount of free resources. We also have some paid trainings, and I'll give you a sneak peek into some of the software that we've developed as well that will be available for advisors in just a few weeks. So. And really what drives the engine behind a lot of what we do is our college pre-approval process. So I want to put a few things in context, and then we'll really dig into the financial aid and the 9 key differences in the 2 different forms that are required for the different institutions that are out there. So this isn't a shock, and many of you that have followed us or maybe seen us on other webinars, the cost of college has become a little bit untenable. So a lot of people are looking at this and saying, you know, how do we approach this? Is this thing ever going to stop? And the reality is the demand for college is so high that, you know, 7 out of 10 of our kids that graduate from high school are going right on to college. But as advisors, when we look at this, for one student's education could be anywhere from for 4 years, and I stress 4 years because the majority of our kids aren't getting done in 4 years, but in 4 years, it can be anywhere from $100,000 for state school to as much as $300,000. Some of our elite private schools are exceeding $75,000 for the next school year. So we're looking at $100,000 to $300,000 investment in this education. So what I would suggest as advisors is that we really need to begin to look at this and help families navigate this process and not turn a blind eye because it is such a significant financial boost or impact, obviously. So what we also know is that the student loan crisis is out of control. Those raising costs have obviously put the student loan debt balances on a trajectory that we are currently going to be doing over $100 billion this year in student loans. So by far the largest service provider for that is the federal government. But one of the things I've found interesting as I was looking today, in the last 15 years, we've gone from $250 billion to now approaching a $1.6 trillion debt in a 15-year period. So, you know, we're adding about $3,000 per second. So in the course of our webinar today, we'll add $10 million to our national student loan debt if we averaged it out. So we also know student loans are part of the equation for most families today because of the cost. And as advisors, if we can help them understand that student loans are not the end of the world, but having manageable student loans and creating a process to understand what's reasonable is critical. So we know that it's part of the process for most, but creating manageable student loans is the key. So the backbone of what we're doing is understanding that when we look at college and what we want to help advisors to do is we want to look at this in in terms of, you know, the way that you take a mortgage. Because if you go to get a mortgage, they ask you a lot of questions about your finances, and they're trying to determine what's the maximum loan that they can give you they think you can reasonably repay, right? So if I go in and ask for a loan for this particular property, which is LeBron James' house outside of Akron here in Ohio, where I live in, not far from me in Columbus, I'm going to get denied that loan. And the reason I'm denied is because I don't have those resources. So hopefully, today we want to give you a process, but we also want to help understand how are we getting to the right outcomes for families, and how do we understand financial aid better? Because what we put together is a process that we think is engineered the right way. If you look at this process here, we're going to talk about the number 3. Most families go shopping for schools first, without ever understanding financial aid or what resources they have available or establishing a smart lending strategy. What we would propose is we need to start with creating a good budget for the family. It's a novel concept, but create a budget before we go shopping for school. Establish a maximum student loan amount, which we would say should never be more than you think you're going to make your first year out. And then understand how the net cost at that particular institution is come about. Because we talk about sticker prices, but today what we're really focused on is how do these schools get to determining the financial aid you may receive from a need basis. So that's really what we hinge on, and we use a one-page college funding plan to create that budget for families. This is available out there through our free resources and a guide of how to set this up for families. So I won't go through all the details, but this is where we start with our budget. And then compare that on the back end as what's it actually going to cost a family to attend. So when we look at schools, and we're talking about financial aid today, but really, like I said, we want to start with, let's create a budget, and then let's understand what's driving this to get to what the net cost is to attend. And what we're going to unveil today is these 9 key differences. But if we looked at this family's budget, and then we compare it to what the school is actually going to cost, this student would graduate from this institution with nearly $100,000 in student loans and an $1,100 a month payment upon graduation. And what we want to bring to the table is help advisors help their clients see into the future and what this outcome may look like. And I think that's really important. If we can begin to project what a school's net cost will be, and a key part of that obviously is understanding how financial aid works. So financial aid at a high level, there's really 2 types. Number 1 is merit-based aid, and that's scholarships. That's true scholarships, money you don't have to pay back. We call it gift aid. And on the need-based side, it's actually much more complicated, because there certainly is grants and scholarships, but there's also what they affectionately call self-help, which is student loans and work study. So when we look at these 2 pieces of the puzzle, we're going to focus on the need-based side today, but what we bring to the table, and I think if you can help understand from the very beginning what the family's opportunity is to plan to get additional dollars for school, be that from a merit-based or a need-based. So we use a quadrant system that says, let's figure out what type of family you are first. We've got your budget. Now let's figure out what we think the schools think you can afford and what your opportunities are. So we say from top to bottom, are you high merit or are you low merit? Meaning you've got a talented student, or maybe you don't. And then are you low need, meaning that you probably won't qualify for a lot of need-based aid, or are you high need? And the way you shop for school is completely different depending on which quadrant you fall into. If you're in quadrant 1, you're going to be looking for schools that award aid regardless of your income and assets. And that's probably a lot of our clients and folks that we serve are those folks up in quadrant number 1. They've got talented students, but they're not going to get a lot of need-based aid. And if we look on quadrant 3, really the key there is, if you have folks that fall into this space where they've got talented students and they're probably going to get a good amount of need-based aid, we want to find the best possible school, because the reality is some of our most expensive schools are also some of the most generous. So when we go through this, some of these schools, when we talk about the CSS Profile schools, those are those that actually have a significant endowments per pupil. So they dig deeper, which we'll go through kind of the additional questions they go through and the differences. But the way you shop is very different depending on which quadrant you fall into. It's really the point I wanted to make. So to tee things up, I think it's important to understand need-based financial aid, the basics of the formula, which many of us probably understand that are on the call. But the basics are, if you look at the cost of attendance at the school, that's the all-in cost, room, board, books, fees, the whole cost of attending that school. And then these formulas and these forms that we're going to go through today determine your expected family contribution. So the way that I think of expected family contribution, it's the minimum amount that that institution, that formula thinks you should be able to afford for this year. It's the minimum amount they think you should be able to afford out of your resources for this year. So if we have the cost of attendance at the school minus our EFC, that's going to give us our financial aid need at that particular institution. So I give a couple of examples here because a lot of times people will ask, well, when are we ruled out of financial aid? And my answer is always, like it is with many things in college, it depends, right? So if you're looking at a school that costs $50,000 and they've determined your EFC at that institution to be $20,000, you're eligible for $30,000 of need-based aid there. So the caveat there is just because you qualify for $30,000 does not mean they have $30,000 to give you. It just means that that's what you've demonstrated you're eligible for. Some schools will have all $30,000, and all $30,000 will come in the form of grants and scholarships and gift aid. And that's a great school to find, obviously, if you're a need-based candidate. Other schools, maybe they only meet 50% of that need. And then they also give you some of their financial aid is going to be in the forms of loans and work study. So, the way the financial aid policy works and what you can expect to receive is really, I think, the secret to helping navigate what the net costs are at institutions. So, the other piece there, if a school costs 20, your EFC is 20, you're eligible for $0 of need. And one of the things that we always say too is let's determine this early, because if you are a need-based candidate, how do we find schools that are going to give us the most money, right? So based on need, and that's really where our focus is today as we uncover some of these key differences in the two forms. So I think the key is to understand that there's the applications, and then there's the formulas that are used. So there really are two primary applications. The FAFSA, which is the free application for federal student aid. Many of us are probably familiar with that one. And then there's also the CSS Profile, College Scholarship Search Profile. And that's administered by the collegeboard.org. At the highest level, the federal method, federal formula, and federal method is the FAFSA is what you're applying for there. And the FAFSA really, when we talk about it's a free application for federal student aid, that is for Pell Grants, and it's for eligibility for any of the government programs that are out there, the federal programs that are out there. So be that in the forms of loans, work study, as well as grants. That's really what we're filing that FAFSA for, to be eligible for. And the majority of schools also use that even to determine if your eligibility for any of the institutional based aid that they may have. So vast majority do that. So somewhere between 300 and 400 schools use an additional, it's in addition, it's not either or, it's in addition. So you file the FAFSA for every school, but many schools, which will show some of these schools, you also file the CSS profile. And that's going to drive what they call more of an institutional formula. So that institutional formula, one of the things to understand there is that that's to get institutional money, right? So you're filing this form, they require a lot more information. But as I said, a lot of times these are more, the sticker price is more, but they also have very generous financial aid packages for need-based financial aid. Most of the schools that fall in here, they require this additional information. They're digging deeper, but they also have deeper pockets. So they're trying to really figure out what do you have to that you can provide, and they really do want to give you a fair financial aid award. And as you'll see when we go through this, if you understand the differences and how these different institutions may look at things, it can really help you navigate which schools may be the best for you to apply to and to consider, and what types of schools. So just to, there's always a list. You can Google CSS Profile participating schools every year. It updates a little bit from year to year. For the most part, it's all the same. A majority of them stay the same and stay pretty consistent. So one thing I'll say as we go into this too is we look at these schools. This process with these CSS Profile schools, these are some of our most elite private universities that are out there. And these things change from not only from formula to formula, but from year to year. these schools use an institutional formula where they have professional judgment over to determine how they're going to look at you. So one school in here may look at you differently than another, and I'm going to give you some concrete examples of what I mean by that. So just because you're filing this one form, the institutions themselves still have the latitude to use their judgment to determine what they think you can afford, and that may be very different from school to school, even though it's the same form you filed. And again, I'm talking at a high level today. Every school is going to be a little bit different, and my general recommendation is, until you get familiar with this process, if you're really going to help a family through this, it's going to require some homework, knowing these key differences at a high level, but then also confirming those with the institutions themselves, because it can change from school to school. As I said, like many things with college, you got to kind of unravel the pieces, and it depends on your situation of how things may shake out. So again, the applications, the FAFSA and the CSS Profile, driving the federal formula, and then the institutional formula, also called the federal method and institutional method, to determine your family's EFC. So the timeline, I think, is important to understand as well. The good thing is that both forms open up at the same time on October 1st. So just this little timeline I like to lay out, and I think it's helpful for families that you may serve to understand as well what to expect. So if you have a senior right now, they're going to be going off to school. They're a class of 2019. So right now, they should be getting their college applications in to the institutions by November 1st, is what we always say. I bring these things up because when we look at these profile schools, many of them have the scholarship application deadline aligns with their early action deadline for admission. So when we're looking at some of the key triggers, November 1st has been one of the earlier dates. I have seen as early as October 15th. But I point these out because these deadlines, if they are missed, you can get ruled out of any scholarship dollars that are out there. You may still qualify for need-based aid, but some of the scholarship dollars go away if you don't have it in on time. So the timeline, the FAFSA and the CSS Profile both become available November 1st, so that's a commonality there. We get all of ours done in October for our first-year students. And one of the keys that I wanted to bring up as well is that your freshman year is the most important piece here. So your freshman year for the FAFSA and the CSS Profile, that determines what's called your base year. So if you're going into the freshman year and you're a class of 2019, this is the year that is critical. And as we'll go through some of the differences, the FAFSA you will file each year while the student is in school. But many of the schools that have the CSS Profile only require that in year one. So you want to check with the school specifically. Do they require it in subsequent years, or is it just in the freshman year? So that's kind of a key thing to understand too, because the CSS Profile is a bit of a bear to fill out, but fortunately, like I said, for a lot of schools, it's just that first year. And the reason is they're really trying to package up a 4-year deal for you. And I think that's actually of benefit to families and to us us as advisors. Things will change year to year, and if things become significantly different, you want to let the schools know. But essentially, most schools are trying to package up and make a very desirable offer on a 4-year basis. So that base year, freshman year, is a key, and understanding that in future years that may change. One of the key things that happens oftentimes is overlap in students. So that has an impact. Obviously on financial aid when you've got students that are overlapping. So understanding that that's something you need to make sure the school understands, that you've got 2 students in. Our expected family contribution is for the family, not for everyone, for each one rather. So I wanted to just touch on that real quick. Because one of the key differences is how do they look at those split students. So if you've got 2 students in school, the FAFSA and the federal method, essentially what that method would say is that your EFC is split. So if it was $20,000, it'd be $10,000 each. In using the the CSS Profile schools, it's not going to be quite 50-50, but they do give you about 60%. So they do give you quite a bit. So it's not just 50, but 60% of what that EFC for each student is really what they would look at. So something to be aware of as you're planning for all 4 years of the cost of college. I'm not going to go through the kind of how they're determining everything, but the asset figures that are used. And when we go through some of these key differences, the assets are really as of the day you file with both forms. So your asset makeup, your net worth, and your balance sheet, it's as of the day you click the button and submit. So there is the ability, if there's some ability to make some changes to your asset makeup to benefit you, to qualify for more aid, you can do that up to the time that you file the forms. The tax years, if you have a class of 2019, your tax figures are already locked in. So there's good and bad to that. The good part is you're going to file the forms and you already really know, you can predict. If you've got younger students, understand that the tax year figures that are used, particularly for the federal form, they're using the prior tax year now. So that's the spring of the sophomore year and the fall of the junior year of high school is that base year. That's the year you want to look as poor as possible. But that's kind of an important piece to understand as we're going into this as well. So that's kind of the timeline, the big picture, establishing that budget, understanding that net cost is what drives our decisions at the end of the day. And then these are some of those key areas. So these are some of the things that I put together just to point out that these are really, I'm going to go through the 9 key differences with the 3 different methods here in a second. These are some things I wanted to point out in addition to the 9 key financials. So I mentioned one was the CSS Profile. It's really used for institutional awards. Like I said, a lot of these higher sticker price schools actually have very generous financial aid awards. The CSS Profile, they do not publish their formula. That's a key difference. The FAFSA, there's an EFC reference guide, formula guide that comes out every year. You know exactly how that's figured out. You can do it with pencil and paper. Just came out here a few weeks ago, not long ago. So it establishes things like asset protection allowances and income protection allowances. But the CSS Profile, it's a little more unknown. There's a couple of reasons there, but the biggest one I would say is it does establish a baseline, but each school can ask different questions than the other. So I put there's over 200 more questions that could be asked on the CSS Profile. Each institution doesn't necessarily ask the same questions. So to figuring out how they want to utilize the CSS Profile, it's kind of free form for them. And they can add different questions in about things like future income, past income. And really what the whole profile drives on is professional judgment of that financial aid administrator that's building that package for your student. And I got to say too, knowing some of these financial aid administrators and working with them over the years, they really do want to provide a fair award. So they do want to understand, they've got a much deeper understanding. It's not as cut and dry. They're willing to work with you, particularly if you've got special circumstances. That's a key part of the profile. Whereas the FAFSA, unless it's really something extenuating, there's really not a lot of wiggle room within the federal form. Whereas with the profile schools, they really do want to give you a fair financial aid award and help you, as much as they can, to the extent they can. At the same time, for those that have financial resources that get ruled out, we'll go through with some of the ways they look at things, but just understand they expect you to be able to pay. So that's what some of that's based on. So one of the other keys here is how do they look at, we talked about the federal form really just looks at the prior tax year from a financial standpoint. So they're just looking at that year's income. And they also, on the federal form, they use what's called a data retrieval tool from the IRS. So that data retrieval tool goes out and picks up all your information from last year's taxes and pulls in the vast majority of what you need from an income and tax standpoint right into the FAFSA form. So it's actually decreased the errors significantly on the FAFSA, and it's also sped up the process significantly. So the FAFSA really these days is relatively quick if you've got a balance sheet and you can pull in the the information from the IRS, that's become fairly quick. Whereas the CSS profile, in most cases, digs much deeper. They're going to ask about sometimes, your past, like the prior tax year. They're also going to ask about your projected current year, and oftentimes what your future income and expenses may be. So I mentioned expenses because the FAFSA does not ask about expenses. It doesn't ask about mortgages or medical or any of those things. It just asks what's on there. It wants to know your assets and your income, and that's about it. Whereas the CSS profile, like I said, trying to create a more well-rounded, they actually ask, do you pay for private K through 12 tuition? And most of the schools will give you a little bit of a benefit in the form of additional financial aid if you're paying for private school. These are all private schools, so they believe in a private school education. So they'll actually give you some credit if you are paying for private K through 12 for younger siblings. So I think that's an important thing to know. And then they'll also ask about medical expenses. So that's on there as well. And then there's on the FAFSA form, all these pieces of the puzzle, you really just put in your data and you submit. Whereas on the CSS profile, at the end, there's actually a place where you can write in special circumstances. So things like, I got a large severance package, but I've been out of work for 6 months. Your tax information isn't going to show that, right? Or we've got a significant medical expense. You've got a that we're dealing with, we're making payments on. So the FAFSA form is not going to ask that, but those are things that you can add in on the back end, legitimate financial strain that's on the family that they should know about. I'm caring for a parent full time. Those types of things that are extraordinary, let the schools know, and that professional judgment oftentimes can result in an additional financial aid. The next piece here we talk is the free application for federal student aid is free. You do not need to pay to file it. However, the CSS profile does have a small cost. It's $25, and then it's $16 for each additional school that you're applying to. It should be noted that there are waivers for income levels. I believe it's below 45,000 this year. So if you are a lower income family, don't rule these schools out. Don't let the cost be prohibitive. There are certainly waivers available. So we talked about these last two, the FAFSA using that data retrieval tool. And then also one of the keys is that the FAFSA needs to be filed each year, and that the CSS profile may not need to be filed every year. Check with the school specifically if they need that additional form for future years. But in most cases, it's just that first year. So again, it's not an either or, it's an and. So we're submitting the FAFSA and the CSS profile. So where the plot thickens a little bit is what comes into play, what's called the 568, the President's Group. So this is a group of folks, colleges, 24 schools that have come together, and essentially, you see it right in the middle of the picture here, they use what's called a consensus methodology. So we've talked about a federal method, we've talked about an institutional method, and this small group of a select group of schools uses what they call a consensus method. So it's really based around the institutional method and the CSS profile, but these schools come together each year, and essentially they try and determine what's a consensus that we can come up with so that we can all look at things the same way, and we're not all subject to a lot of big variability as far as it relates to our financial aid that we're awarding. And all these schools too, they award, you see on the left there, need-based aid is a key part of their tenet. They don't want money to be a barrier to economically disadvantaged students. They really want top students to come, and if you have need, they'll meet 100% of it. So, or very near 100%. So if you have financial need, a lot of these schools that on this list cost $65,000 to $75,000. A lot of students would rule those schools out, where if you have the ability to get into these schools, these may be your most affordable choices, and oftentimes they'll pay for 100%. So understand how that works. A couple other key things with some of these schools to understand with financial aid is I point out that the term need blind. It's something that I think gets confused in the process oftentimes. The definition of need blind. really need blind does not have to do with dollars, it has to do with admissions. So what they're saying is we want to admit these students at our schools based on the merit of the student, not based on the fact that mom and dad can pay full price. So that's what these schools have said. They'll be need blind. So the reality there is that some schools you may have a leg up if they understand, your last name's Kennedy and you're in the family, right? So they know you can afford it. So that may give you a leg up from an admission standpoint. But these schools have really said we want to have it be fair, and we want kids to get in based on their merits. We're going to be a need blind schools. So that group, it creates a little bit different formula as well. So here's the 9 key differences that we break out, and I've got a couple of supporting slides here as we go. So in our course, we go through these in great detail, but obviously you can see even before I get into these, there's a lot of different pieces of the puzzle. But when we look at the difference between federal method, institutional method, and consensus method, the consensus method, they use the CSS profile. It's the same form. They just look at things a little bit differently than when they look at your resources. So from the top down, asset protection, the FAFSA gives you a small asset protection allowance, just basically saying you can have a little bit of these funds as like a cash reserve. Based on the age of the oldest parent, you can have a certain amount that we're not going to assess, whereas the profile and consensus, basically every dollar that you have in non-retirement is going to be looked at. So other pieces of the puzzle, basically it's non-retirement, like I said, so cash, cash, mutual funds, 529s, all those things. FAFSA is 5.64% at the highest level. It's actually 2.4 to 5.64, but 5.64, it's the highest level. I don't have time to get into where the 5.64 comes from in this workshop or webinar that we're doing, but the profile and consensus, they just say it's an even 5% is what they're going to look at. And that's in the parent's name. And then another key is how do they view small businesses? So what defines a small business? So within the context of the federal formula, essentially, if you own more than 51% of the company and it's a small family-held business, as long as you have less than 100 employees, it's not an asset that they look at. So whereas the CSS profile and the consensus, they are going to consider your small business as a resource to pay for school. So how do you value a small business if there's not a true valuation? So I'm not going to dig into that today. It is something we go through in the course of how you report, but just really from a high level, understand that if you have 100 employees or less than 100 employees, your small business is not counted against you in the federal method at all. So, but the profile and consensus would want to know what kind of resources you have within your business. Next one down, non-qualified annuity. The FAFSA does not ask about it and does not count against you, whereas the profile and consensus schools, the vast majority of them are going to assess that as a resource. Now, I know there's restrictions about accessing those dollars. As a financial planner, we know these things, but they are going to consider that. So some of the strategies that we see out there, or advisors rather, that may encourage people to put money into certain products. That's not what we're about. It's not what our training's about, but understand that yes, it may be off for the FAFSA in a non-qualified annuity, but the profile and consensus, most schools are going to look at that. They're looking much deeper. They're trained much differently. So the non-qualified annuity is a big one. And then these last few are really probably the ones that make the biggest impacts. And I've got a couple of solid examples around each of these. So number one is home equity. The FAFSA does not ask about it, and they do not consider home equity as a resource. Whereas the profile schools, it varies. So I say it varies because some schools, many of them base it on percentage of income. What the consensus has said that the maximum we're going to assess your home equity is 120% of your income. And I've got an example to kind of drill that home. Profile schools, some of them, the highest I've seen is 3.5 times your income that they would look at in terms of home equity. Some of them don't look at it at all. So, so it just depends on the institution, and that's where we say institution, year to year, things can change dramatically, and that's a big one. Home equity can change year to year as far as how they look at it. But we know that FAFSA schools do not consider it as a resource. And there's a handful of the consensus and institutional schools that don't look at it as well. So that's home equity. I'll give an example here in a second. The other one is assets in the student's name. So if the student has, let's say, an UTMA or an UGMA account, used to be obviously a very popular tool to save, and a lot of grandparents still have that, particularly from a gifting standpoint. We know in Saving for College, obviously, that the 529 is, when we look at this, the 529 plan is going to be considered an asset of the parent. And it's worth noting that the asset in the student's name. So we don't see it very often because I think we've done a better job of educating folks, but once upon a time, we would have 529s where the student was the owner and the beneficiary. Student's the owner and the beneficiary of a 529 plan. And what the FAFSA has said, they've given pretty clear direction that if you have that case where the student is the owner and the beneficiary, you should still count that in the parent's resources. Because otherwise, anything in the student's name is assessed at 20% versus 5.64%. Whereas the profile schools, the institutional method, have said if it's in the student's name, we're going to count it as a student's asset because they have control over it. So you can see that swing because we're talking about a swing from 5% to 25%. You can see they look at the student assets a little bit more in the student's name on the institutional versus the federal. And if you also see on the far right, consensus schools, when you've got dollars in the student's name in the trust account, they look at it all the same. So it's 5% as opposed to 25%. So some of the top schools, and I'll show you a real life example, that's going to make a big swing. It's going to make a big difference, right? And in that same vein, when we look at assets in a sibling's name, the FAFSA does not consider those as a resource. So if you've got grandpa and grandma have, 3 trusts for each of the 3 kids in your household, the FAFSA just wants how much is in the student that's going to school's name, whereas these other schools say, what do your siblings have? And they're going to count those as well at 5%. So it's not a bad assessment rate, but still something to be aware of, particularly if there are large trusts and you're a need-based aid candidate. So those are the asset pieces, and I do have a couple concrete examples. The non-custodial parent resource. This is probably, I would say, I don't know what the exact percentage is, but a lot of folks that are in a divorced situation are really trying to figure out and hammer out how do we pay for college and how does it impact financial aid and what's the best way to apply. So essentially the way this works for the federal method and the FAFSA schools, they only ask for the parent that you live with the majority of the time. So the custodial parent is defined as the person that you live with the majority of the time, right? So if I'm divorced and my ex-wife is a surgeon and makes $500,000 per year, if I just look at FAFSA schools and my son or daughter lives with me the majority of the time, I'm going to file the forms and they're going to look at my income. If I only make $50,000, they're going to look at that instead of pulling it in. So, and I'll show you an example of that here in a second too. So that's the non-custodial parent rule, whereas the profile schools, the vast majority of them do ask for what they call the non-custodial parent to submit a CSS profile. It's a little complicated. So in a divorce situation, I would file the FAFSA as the custodial parent. I would also file the CSS profile. And as you go through the CSS profile at the end, you list out all of your parents, and step parents. So, you list everybody out on the form, and then you ask, who's custodial, who's non-custodial. And then the way this works now is you plug in the email of the non-custodial parent, and in theory, it should alert them that they need to fill out this non-custodial profile. So I would be cautious if you have that situation where you're helping someone in this scenario. Make sure that the parents know that it's coming, and make sure that the non-custodial parent knows that they have to go in, create their own profile, and fill out that form on their own, because it's a privacy thing. Obviously, you can't be expected to collect your ex-spouse's financial information. So that's a really important one and a big swing. So in those scenarios, oftentimes we say, let's have the student, if it's joint custody, live with the parent that's less financially successful, more in that year, and then make sure that we're focusing on FAFSA schools. And there's a few CSS Profile schools that do not look at the non-custodial parent, but all of the consensus schools do if you are in that situation. Okay, so a couple examples, and then we'll get into some Q&A, because I'm sure there are some as we've been going. So home equity. I had the actual schools listed here. I decided to take them off because this can change from year to year. So which schools use what. But at a high level, this is a real life case that from last year when we looked at financial aid awards. So these are all real scenarios. These aren't made up. So we looked at the family income was right around $100,000. And what the institutional method versus consensus method, this particular school. So the FAFSA wouldn't look at this home equity at all. So if they have home equity at 500,000, the FAFSA method is going to kick it out and say, we're not going to look at that. In this particular case, the institutional method school we looked at, they said, we're going to look at this, but we're only going to look at it up to 2 times your income. So, they're not going to look at all 500,000 of equity, but they are going to look at 200,000, and they're going to assess that at 25%. So that's the key there. So, and then, so it's $10,000. They would say that you should be able to contribute from your home equity. $10,000, they think you should be able to contribute from your home equity. This is also a case when we looked at the student, if a student has an asset in their name at 25%, if a student gets assessed, it'd be $10,000 of EFC from the asset as well. So the home equity is really the one I wanted to drive home here, that, they look at a percentage of income, so $10,000 of EFC. And here's the one I broke it out based on the student asset and that impact on EFC. So the student asset, if there was $100,000 sitting in the account, 25,000 would be in the institutional method, where it's only $5,000 would be expected to be used in the consensus method. And we really saw this come full circle when we had $100,000 in trust for a student. So one school on the left using institutional method, school on the right using consensus. And you can see that the EFC was roughly $20,000 less. So obviously that drives down. These are both schools that meet at or near 100% of what your need is. You can see it obviously drives down the out-of-pocket cost. And these are both high-priced schools, but just that difference in having in the methodology created a significant difference in the ultimate net cost of the school. So I wanted to do one more example here, if we can. So in this one, this screen's a little bit different, but this is kind of a preview. College Aid Pro is our software that's going to be released October 1st. If anybody wants to use our methodology and use our systems to work with clients. I pulled this up because it does a good job of illustrating a divorced family situation. So you can see from the far right, we figure out what the pre-approval message is, what the pre-approval amount is on the far right. But it also, in this case, we had the mother was applying for the financial aid. So the federal EFC just looked at her financial resources, whereas the institutional and consensus methods, when we pulled those in, you're going to see those EFCs are over $40,000 more in the institutional case. And you can also see the differences in consensus and institutional. This had to do in this case because of some assets in the student's name. So you can see in a divorce situation just how dramatic that EFC difference can be between the different methods that exist out there. So, and that's why we're on here. What we try and drive to, and everything that we do. What's the 4-year net cost to go to this school? What's our budget? And then what's our funding gap if we have one? More importantly, if we use the funding gap and we use loans, what's our loan payment going to be when we're done? And we want to drive home, what those loan payments are, because I think that's what hits home really with parents and families. So I will just circle back and make it full circle, because what we look at is if you can create the budget, help people see into the future, help them understand, hey, here's the cost. Can we afford it? this is looking at all 4 years down to the penny. How do we pay for it year by year? This is really what we got to drive home and help people understand. What's that monthly payment look like? If I'm 22, 23 years old, $1,100 a month payment on a $50,000 a year salary doesn't feel very good. Whereas if we can find schools that are within our net cost, that are manageable for us, that keep us in reasonable student loan debt, that's really what our whole process, and hopefully illuminating some of these differences in the formulas, how you can get better outcomes for families, is hopefully helpful for you. So I will close and then we'll come back for some questions. But one of the things we say is we give away a lot of our information, and we're happy to do so because we do have a movement to end the student loan crisis. And there's 3 ways that we really help and serve advisors in this capacity. One is, you can be the expert. So if you want to learn everything, we've got the resources and tools to train you, and soon we'll have the software to help you facilitate the conversation. Number 2, a lot of times we work with a number of kind of top firms, and they've said we're going to anoint kind of the college surgeon within our practice and have an expert on our team. So, like many things, you may have a tax expert or an estate planning expert. With college funding, younger advisors, this is a great way they can add value and help you with your college-bound families. And it's also a way to retain clients and bring in the next generation of investor. So that's something, if you are an experienced advisor and you've got a little more, you have a little bit older clientele and they're getting into their 60s, their kids are now in their 40s and college is their number 1 concern. If you've never met them, having a college conversation is a great way to bring that up. And then the third way, if you want to just outsource to an expert, that's something you can do as well. Connect with us and we can connect you with our folks that really just work on college and help be a part of your team. So this isn't a total sales pitch, but if you want to learn more and you want to learn how to do this training the right way, you can visit us online. And I know Katie will be sending out communication on exactly how to connect with us. And then also you have a significant discount. We've got 2 parts. One is, just for the mechanics of college funding. So you can do the mechanics of college funding. It's 20% off. It's usually $1,000. It's only $800. And then there's a special also for the full course, which includes the full marketing, college, and building a business. So it's got white label PowerPoint slides and brochures that we build for folks so that they can take this message and take it out to their community and make an impact. So hopefully that's helpful. I'm happy to take some questions. I hopefully left a little bit of time for it, but it's actually, we've got a pretty decent discount. So I think it's $23.99. So it's actually 30% off on the full course as opposed to the 20 that I have there. So, but I know Katie will be sending out kind of how all that will work going forward. So with that, I'll take questions on anything we have and go from there.
Okay, Joe, we have a question from Chris who is asking about graduate school loans. He says, you mentioned earlier in the webinar that there's a rule of thumb for how much debt is reasonable, being no more than your anticipated first year's salary. But he's asking if there's a similar rule of thumb for a student who is attending graduate school, since that's frequently funded by loans. So the same rule of thumb might not be doable for most students.
Yeah, it's a great question. It's coming up more and more often. So I think the rule of thumb still holds true because the reality is the reason we have that rule is it gets back to kind of a 10% rule. So for every $10,000 you take out in student loans, you're going to owe roughly $100 back on a 10-year repayment schedule. So if you take out $100,000 in loans, you're going to have roughly $1,000 a month payment, which should be doable if you're making $100,000. $50,000, $500 per month. So I think a lot of times the rule still does make sense. But I will say that graduate school loans are a big part of the problem out there because there's not really a promise. One of the big ones we see is something like law school. Going to law school doesn't guarantee you're going to make anything. So, but you can take out $60,000 in student loans to pay for that for a couple of years, and all of a sudden you've got well over 100,000. If you've got some undergrad, you know, there's a big drag. So when you're coming out because your income shovel, it's not guaranteed. So so hopefully that helps, but I think the metric still works, but I still think people need to be cautious about what their investment is into that next level of education, be it an MBA or something like that. So medical schools and dental schools, obviously those pay off. Those are, you know, the folks have debt from those, but I still, you know, you want to try and keep it manageable, but some of the graduate degrees, there's just no guarantee of what you're going to get out of it.
Mm-hmm. Okay, and then Dan is asking, does the CSS profile consider the value of whole life insurance, such as cash value or benefit, as an asset?
No, it does not.
Okay.
So, and I'll bring up one point on that too. So no, they're not going to ask for that, but they have just in the recent years began asking for retirement account balances. They swear up and down that they're not looking at that as a resource, but they are asking it on the profile now. Most schools are. So just be aware. Don't be surprised if you see it when you're filling out the forms. So.
Okay, we have a question from Patrick, who is asking if you're familiar with bar loans for law school students, and if so, how do these work and what options are available for refinance and repayments?
I'm not really the student loan expert on kind of the repayment side, so I guess, yeah, it's not really something I typically would refer those kind of questions to Heather Jarvis. Would be my #1 resource for that stuff.
Okay. And then we have a question from Dean, who says, you focus on the asset side of the equation, but how does the income side factor into FAFSA and CSS? For example, some clients want to use their Roth versus the 529, but doesn't that withdrawal then penalize the family in the following year due to the income test?
I think I understand the question. So I'll give a kind of a rule of thumb, is that the CSS profile, they look at assets quite a bit more and income a little bit less than the FAFSA, the federal schools. So that's kind of a general rule. But in general, when we look at income, what they typically, if you just want to have a decent idea, roughly 20%, 20 to 25% of your income is what they think you should be able to afford towards the cost of school. So if you make 100,000, your EFC is roughly 20,000. Make 200,000, it's roughly 40 to 45,000. They think you should be able to pay out of income. So when we're talking about, it was kind of I was trying to figure out really the essence of the question, because they do look at income. It's the largest driver of EFC. And I think the question had to do with what if we use resources like a Roth or 529. I mean, the 529 is going to be tax-free if it's for education, so that's not really going to impact future years. So I'm trying to understand, is he asking, the Roth would create some small, potentially earned income tax, but minimal. So
yeah, so I think I agree. I think that's what it was asking as well. Because we often say that it's better to use the 529 because of that income that the Roth would generate.
Yeah. So, and it's usually minimal on the Roth, but just understand it will generate some, and it could impact future years. I would say too that careful planning with outside resources coming in and generating earned income, that can disrupt. But by far, when you get the financial aid award letters back, understand if you have 4-year renewable scholarship or grant dollars, if they're 4-year renewable, they've packaged that up, and you can really, I wouldn't say ignore, you still need to apply for financial aid, but if you read the details on how you qualify for those, if they're 4-year renewable grants or scholarships, you don't need to worry as much about financial aid planning in future years. But if it is a grant, it's based on need for that year, then you need to be careful with your planning.
Okay, we've got a few more questions here. Stephen is asking, is there a separate application for the consensus colleges?
It's a good question. So they use the CSS profile as their form, and then each school that uses that, they can have, there's literally 200, over 200 questions. Each school can select basically like their supplement. So they can say, I want, these 5 questions in addition to the standard questions that everybody has. I want these 5 questions or 10 questions. And then also to add on to that, a lot of schools you have to do the FAFSA for federal aid. You've got to do the CSS profile from the institutional aid, and then some of them have their own supplemental forms that you also have to fill out to either for admissions and for additional dollars. So it's a good question because you want to understand each school. Do they have school specific forms in addition to FAFSA and the CSS profile? So it's a really good question.
Okay, and then Stephen is also asking, do any of these applications ask for grandparent-owned 529 plans?
So the FAFSA does not, doesn't ask about it. The profile basically has a way of just basically saying, is there any money that you're not telling us about? It's an eloquent way of saying it, but they do ask, is there other resources that have not been asked about yet? That's kind of how they say it. So for the most part, if it's grandparent 529, it's not going to be reported. The key is how does that flow back into the system? So if you're using that for the freshman year and it comes directly from the grandparents into the system, they're going to pick that up at many schools and count that possibly as untaxed income the next year to the student and assess it at 50%. So it's a lot of time not the asset that gets that hits the board because it's not really assessed, but if it comes in from them directly to the school, they may pick it up for the next year. I've seen that impact folks and it disrupts the future financial aid, but I've also seen it not really have an impact at certain institutions that kind of just don't catch it or ignore it.
Okay, Stephen is also asking, is the SAT score becoming less of a factor in college admission?
Well, it's approaching 1,000 schools that are part of the test optional movement. So from an admissions standpoint, I'm by no stretch of the imagination an admissions expert, but I will say that particularly for our folks, I think the ACT, SAT, when we work with families, most of them are not financial aid candidates. So even though a test may be optional at the school, if you want significant dollars, scholarship money, that's where it comes from, is having good test scores. So hopefully that answers the question, but there's a whole list of test optional schools out there from an admissions standpoint, but from a financial aspect, schools are trying to raise their academic profile each year, and they're willing to discount great students. And I guess I want to round that out because we didn't get into it a ton today, but one of the things that we really drill into is how do schools award financial aid? Are they need-based schools? Like all of the schools on the President's Club, for the President's Group, for example, they don't have merit scholarships at those schools. They have need-based scholarships. So you may get in, and they would love to have you, but if your financial resources, if your EFC is 75,000 or more, you're going to pay full price at those institutions. With some exceptions, less than 0.5% at most of the schools get any merit scholarship money. So that's an important piece of the puzzle.
Okay, Dan has a question about your product that you offer. Is software part of the package?
Software is separate. So the training, there's the training that is packaged up, and I know you're going to send out the follow-up how to get the discount for Saving for College folks, but the software is a separate piece. So we've got education. It is the one part that with your discount through Saving for College would be $7.99, and then the marketing, which includes PowerPoints and brochures and all those things, the two together, it's $23.99 with the discount. So, and then the software is just a separate ongoing, like most of our other planning software. So, if you want more information, you can on that. You can visit us online, or feel free to email info@Capstone College Partners, and we'll get you additional information. It's just we have it in a test group right now. It'll be officially launched October 1st for sale.
Okay, well, it's about time now. We're up on our hour, so I don't want the webinar to shut down before announcing our winner of the free book, which is Paula Birmingham. So Paula will reach out to you and arrange mailing of the new book to you. That's the updated edition of SavingForCollege.com's Complete Guide to 529 Plans. And Joe, I just want to thank you again so much for being here today. Great presentation as usual. And everyone, please keep an eye out for an email coming from savingforcollege.com that, as Joe mentioned, it'll include the links to sign up for the discounted course as well as the form you need to complete for your CE credit. Joe, did you have any final thoughts before we end?
I did not. Thanks for having me. Hopefully it was beneficial for everybody. Had fun doing it.
Okay, great. Thank you.
Thanks. Bye.